Okay, so today we will proceed on with recording mode. Okay, so I don't think there's much recap, right? Last week we did PED, PES, yes? So we already did PED, PES 3 times already. I don't think. Okay, but today we'll still have PED. Today we'll still have. I just give you a warning first. Okay, so I just want to have a quick check. Where is your school currently at? What topic are they covering?
We just finished the elasticity. Yeah. So we are working on the case studies.
Case studies. Have you all learned tax and subsidy already?
Yeah.
Not yet, Okay, so today I will be Sorry?
I think we're starting that this coming week.
Okay. So today I will be a bit faster. Okay, but the good thing is H1 there's a lot of things removed. And likewise for the H2 this year also a lot of things removed. So you got to know what's your course code. Okay, so the course code that you'll be sitting for is for H1 is 8843. Okay, so I just want to point out, okay, especially if you are retaking A-levels. I don't think as for whoever that's watching this, if you're retaking A-levels, tax and subsidy has undergone a real big change. Okay, so this is the latest change in syllabus. You don't need to know tax and subsidy incidents anymore. Okay, which probably means that there are some things in the book, I'll point it out to you, that you don't need anymore. Okay, the book so needs an update. Okay, so having said that, what is tax and subsidy? Let's quickly run through. I will be running through WETPIGS again. Okay, so tax and subsidy is an extension topic of WETPIGS. Okay, just like PED is an extension topic of your Egypt. Okay, so tax and subsidy is an extension topic of WETPIGS. Okay, so there's a particular alphabet that will be affected. We will be running through basically the definition of tax and subsidies. I will be differentiating a direct and an indirect tax. It's not that important. Wait, this year you may be, H1 students may be doing macro. Likely to be, but still not that important. Okay, this is more important in your second year. Okay, so direct, indirect tax. I'll also be differentiating a lump sum and the ad valorem tax. Okay, again, from the exam perspective for H1, there's not a lot of exam value here. No need to know that in depth. Okay, but today we'll also be drawing a lot of things, illustrating tax revenue and subsidy amount. So if you want to draw, this is the best time to draw. If you have a writing block, drawing block, your colorful pens, we'll be drawing quite a bit of things here. Okay, and I will also be showing you how your tax revenue can differ, when PED is different. Okay, so remember, PED is still going to be significant here. I'm going to show you in a short while, and this will be tested in your practice question later. Practice question will show that. I won't be going through consumer and producer surplus. This is for H2 only. And quickly run through the exam purpose. So today I expect to end approximately 8:15-ish, 8:30, about there. I do need your help and support. So the more you participate, the faster we can end. Clear? Okay. WETPIGS. Do you have your book with you?
Yeah.
Okay, so let's go through WETPIGS. Where is... Yep, this is the one. We will be looking at page 6. Page 6. So specifically for page 6, I want you, for those who haven't annotated on the book, to focus on government policy. Sorry, this is a typo. You want to talk about tax and subsidy. Tax and subsidy is specifically going to affect your supply curve. So today we are looking at this particular alphabet, G, and how it's going to affect your supply curve. So a tax, is going to what? How does it affect your production cost with a tax? Higher or lower?
Higher.
Higher cost of production. Okay, so supply curve is going to shift where? Left or right? Left, good. Okay, a subsidy on the other end, lower cost of production, and this will cause your supply curve to shift to the right. Okay, so this is the very basic. Okay, you have to know this. Oh, so we have conducted this before. I'm not going to go through this any further. Okay, so this is a recap. Okay, today we are going to dive deeper, and there are a couple more extension topics down here under tax and subsidy, okay, which I will share with you later. Okay, so it will go deeper and deeper. So today we are going to go down. Okay, we are not going to go sideways. Okay, so okay, page 19. Okay, so for those with the book, okay, I want you to reference to page 19. Where is my book? Here. Okay, so a tax, okay, and a subsidy, this is the definition. So I just want you to be concerned. Okay, the tax down here, we are concerned, or we primarily assume that okay, down here they didn't make an assumption here. Okay, so the assumption is this can be a direct or indirect tax. Okay, later on I will differentiate between the two. Okay, and for the entire micro syllabus, indirect tax will be the focus. Okay, so you can see that taxes are what? Okay, they are compulsory payment that is made by the individual or firms. This is represented by a transfer of funds from the private sector to the government without any service rendered in return. Okay, so there are different type of taxes that we'll be talking about in a short while. All we need to know is, okay, the government, okay, will collect tax. Okay, so the way how government collect tax is quite creative, right? They can collect from individuals through what? Okay, through personal income tax. They can collect from firms through your corporate income tax. And they can also collect from firms through your GST, or what you call goods and service tax. So there's varied types of tax. All of them can be broadly categorized under direct or indirect. Okay, later on I will talk about them. Okay? And today we are focusing on indirect tax. Okay, indirect tax is going to affect your cost of production. Okay, so this is the focus. This one can ignore for the time being. Clear? A subsidy is a negative tax. In other words, okay, a subsidy means that the government pays the producer, and not the other way around. Okay, so you may be wondering, wow, so good. How come the government will pay the producer to do something? Well, obviously, there are specific objectives to be met. All we need to know that this is a negative tax or payment to incentivize a production of a specific good. Okay, that's why the government is paying the producer. Okay, so the effects is this will lower the cost of production. Indirect tax, increase cost of production. So far so good. Effects on COP is crucial. Next. Direct versus indirect tax. Okay, I'm not sure whether this is in the book. Okay, if it isn't, okay. You can see here. Okay, we have two types of tax, direct and indirect. Okay, this is more specific in macro, in your second year syllabus. Okay, but if you're starting macro, I don't think you'll be using direct tax that soon lah. Okay, maybe next year lah. Okay, that's if you make it to the second year lah. Okay, better touch wood, find some wood to touch. Okay, so this one I will probably skip here. Okay, I won't touch on this first. All you need to know is this is a tax on income and profit. Wealth and profit is the same. Okay, income and profit. Okay, and they are paid directly to the government. Okay, personal income tax, corporate income tax. Okay, firms and consumers are subjected to these two. Household. Right? So today we are more focused on this. Okay, so this is compulsory taxes that are levied, okay, by the government on spending or expenditure. Okay, when there is a purchase of goods and services. Okay, so why is it called indirect? So if you actually look at, if you let's say go to Popular, right? Okay, let's say if you buy a particular stationery, if you look at the receipt, okay, what do you see? Okay, you see that there is subjected to GST, right? Yes. What is the GST rate if you are aware? That you should know lah. Okay, or you find out. Okay, let me know by the end of during the break time what is the GST rate. Okay, so you can see that whatever amount that you pay for, let's say a pen or pencil, is going to be multiplied by the GST rate. So you can see that this is a tax on spending, right? But who actually bears the tax? So you can see that the tax has been passed on to you by the producer. Okay, so let me repeat. Okay, an indirect tax is going to be levied on the producer. Okay, but the producer, okay, they are going to pass off the higher cost to you. So sometimes you see in the receipt, got GST, right? And if you were to dine outside, most of the time you often hear your parents say, "Oh, service charge 10%, GST 7-8%." You hear that often? Okay, so we are concerned about the GST component. Okay, so the GST is passed on to you by the producer. Okay? So at the point of casting this or shooting this, is no longer relevant to illustrate how much the producer is going to pass on the cost to you. How much is no longer relevant. Okay, so we can assume that the producer is going to pass on some cost to you. Sometimes they pass you everything. Sometimes they will absorb themselves. Okay, so if you go to certain restaurants and eat, sometimes you don't see GST. Why? Because they absorb themselves. Okay, sometimes you see GST means what? Okay, they pass on entirely to you. Okay, so remember, indirect tax is applied on producer and they are passed on to consumers. That's why it's called indirect. Understand how it works now? Okay, there's an indirect channel to affect consumer. And an indirect tax, there are two types. Okay, you realize that I'm going on like a steroid mode. Okay, because because of the recent change in the syllabus, they have took away a lot of things. Okay, so I'm also struggling on what to cover, but I also curated some interesting questions for you lah. Okay, I hope we can spend more time in the questions later. Okay, that has more exam value, can? Okay, so now I just want you to focus on these two types. Okay, specific or per unit tax versus ad valorem tax. Okay, so most of the time, put a star here. Most of the time we will be, for H1 especially, okay, 100%. I haven't seen this one been tested for H1 before. On the right side, I put it 0%. Okay, so you can see that this is a per unit or a lump sum tax. Meaning to say the tax amount is fixed. Okay, let's say $2 per unit. That's why you can see that when your supply curve shifts to the left or parallel shift, okay, the vertical distance will tell you the tax amount. Okay, per unit means that, let's say, okay, if this particular production of this good is subjected to an indirect tax of $2, it means that it's going to be more costly to produce the good at $2 more per output level. So make sure you understand that what is per unit means that it's fixed. Okay, so for ad valorem tax is specific percentage on price. Okay, specific percentage on price means what? Okay, so you can see this like a GST. Okay, GST, just like I mentioned, is used to be 7%. Now it's 8%. Right? So you can see that GST on $1 item and GST on $100 item is going to be very different, right? Okay, so a GST on $1 item will result in 180, 1.8. Okay, a GST on, let's say, $1,000 item will be $1,080. So you can see that, okay, you can see that because of an ad valorem tax, okay, the amount actually increases. Okay, it actually deepens. Okay, for if your good is more costly. Okay, if your good is more costly, it's going to be wider and wider and wider and wider. Okay, so for low ticket item goods, okay, you will be subjected, okay, to a in terms of percentage is very little. Okay, but for big ticket items, it's going to be quite substantial. That's why, okay, you're going to see a divergence in your supply curve. So like I say, this one has not much exam value, not much. Okay, so no need to know for H1. I haven't seen this been tested before also. Okay, this one I focus on this. Later on we'll be using this. Okay? Okay, so now, okay, I would like you to draw now. Okay, although let me see, is this? Okay, so join me in drawing. Okay, since we have some time, join me in drawing. This one is quite fun. Okay, so let's draw a demand and supply curve. Okay, and we have your equilibrium price and your equilibrium quantity. Okay, so far so good. So let's say if we have an indirect tax or a per unit tax, okay, of let's say $2. Okay, so we can see that a per unit tax is going to cause a parallel shift of your supply curve towards the left, right? Here. Shift to the left. And we can see that the market adjustment process will be a shortage and an upward pressure on price. That we have covered this under your demand and supply, yes? This one is very basic, right? This will cause a shortage and an upward pressure on price. So today we are not concerned about that. Okay, so now I want you, okay, to label this. Okay, right at your initial supply curve, do you see this point? Okay, I want you to draw a horizontal line here. I'll call this P1 prime. So why would I label this P1 prime? So we can see that this is a per unit tax. Okay, I'm just going to label the per unit. Okay, so this is the vertical distance, tells you this is the per unit, right? Yes? And we can see that at P1, okay, this is where the consumer and the producer transact at P1 at Q1. Higher equilibrium price and lower equilibrium quantity. So far so good? Now, I just want you to focus a little bit. So the exact effects of a tax is a little bit different. A little bit different from your standard WETPIGS factor. So you can see that a tax is levied on the producer. Okay, let me repeat. Levied on producer, pass on to consumer. Okay? So in other words, you can see that P1, okay, will be what consumer pay. Okay, consumer pays for this for the good at P1. And you know that this $2 is going to be collected by the government, right? Okay, so I want you to observe this. At the initial supply curve down here, at this particular point, okay, if you were to draw, if you were to label it to the left side, we can see that P1 prime is what the producer receives. So let me repeat. Okay, because of the tax, because of this particular interesting arrangement, the consumer is going to pay higher. Okay, but the producer receives lesser. So in between, okay, P1 and P1 prime, okay, this is the per unit tax. And if we were to multiply by 0, okay, this is the origin, right? 0 to Q1, okay, this particular shaded area will be your tax revenue. Are you following me? Okay, so I want you to identify the redistributive effects of tax. Number one, producer because of higher production costs, okay, they collect lesser. Number two, consumer will have to pay more, okay, in terms of higher price. So the in-between has to go to government's pocket money, right? So how do we find that? All we need to is just to find out the per unit, the amount of per unit tax, okay, this is your breadth, multiply by OQ1. OQ1 will be the amount that is produced or consumed, net of tax. After tax, 0Q1. So if I have to multiply OQ1 by P1 and P1 prime, subtract these two, this will give you a tax revenue. So let me repeat. Okay, your tax revenue can be found like that. Okay, so P1 and P1 is the difference between your breadth, P1 minus P1 prime, multiply by OQ1. You see that? Okay, so this will be your shaded area. So it's really imperative to find out this, okay, because later on, okay, there's a particular question that requires you to play around with demand curve, okay, and find out the different kind of tax revenue. Okay, up to here, any questions for me? Okay, if you have any questions, you can unmute. Okay, so now, okay, I want you to join me in the second drawing. Okay, the second drawing will look similar, but it is different. Okay, so this is a subsidy, right? Okay, so now let's derive the drawing again. Remember, a subsidy lowers the production cost. Oh, I forgot. Almost forgot. Okay, so we can also see the producer revenue and consumer expenditure as a result of tax. Okay, so I'm just going to label this A, B. So you can see that your producer revenue will be what? Okay, let's go through consumer expenditure. Remember, consumer pay much higher, right? P1, right? Yes? So we will be consumer will be consuming at O, P1, A, Q1. That you following me? O, P1, A, Q1. Okay, this is quite straightforward. This is consistent with what we have learned earlier on. Okay, under the expenditure and revenue approach. But I want you to focus. When there's a tax, producer revenue will not be the same. Especially when there's a tax. So you can see that the amount, okay, that is collected by the producer. Okay, remember, producer collects lower price because of the per unit tax. Okay, so it will be O, P1 prime, B, Q1. Okay, O, P1 prime, B, Q1. Okay, so only when there is a tax, these two will not be the same. One will be higher than the other. Okay, and the in-between, okay, will go to tax revenue. P1 prime, A and B. Okay, this one will go to the government as tax revenue. So far, so good. Okay, P1 prime, A and B. Stitch these four areas up, 4 points up. You'll get that. Huh? So from an exam perspective, which one is more important? Tax is more important than subsidy. Okay, tax is more likely tested, usually tested, more often. Okay, but it doesn't mean that subsidy is not important. Subsidy is still important. Okay, just that tax more important. Okay, so now Remember, let's derive these together. Just now we have derived the amount that tax that's going to the government, right? Yes. Okay, and we also uncovered that consumer pay more, producer receive lesser. Now, okay, this is going to be opposite. Okay, so let's go through this together. So let's say the producers are paid a per unit subsidy to produce more. So this is the effects. We can see that supply curve will shift right. This will cause a surplus and a downward pressure on price, right? Okay, so let me quickly doodle this down first. Now I want you to observe the effects. Okay, so let's say, okay, this is a per unit subsidy of $2. So it simply tells us that, okay, the vertical distance between your supply curve tells us that, okay, for every unit that you produce, it will always be $2 cheaper, no matter which output you are at, right? That's why it's a per unit. Okay, it is a vertical distance. It's going to be parallel. Okay, let's say this is $2. Okay, so you are going to enjoy a lower production cost at all your units. So now I want you to jot a hypothetical line here. Let's call it P1 prime. So you can actually see that at Q1, okay, this is your final production level, right? At Q1, okay, this is what your producer receives. Okay, producer is going to receive a much higher price, okay, but they are subsidized to produce more. P1 prime. So you can actually see, okay, this is what the producer receives. And the consumer, okay, based on Q1, you can see that the consumer is going to pay a lower price. Okay, so based on P1, okay, or rather based on Q1, if you were to jot, okay, a vertical line across, okay, to your y-axis, okay, we can see that this is the amount that the consumer pay. So we can actually see these two things, Okay, I'm going to label this as well, A and B. Okay, so you can see that the subsidy amount, okay, would be the vertical distance A and B multiplied by what? Okay, the amount that is subsidized, right? OQ1. Do you see that? Okay, I'm so sorry, blocking. O to Q1, A and B. So in other words, okay, we are concerned about, okay, breadth multiplied by length. Okay? That you following me? And we can also see that a subsidy is going to redistribute, okay, your producer revenue and consumer expenditure differently. Okay, so you can see that producer revenue will be higher, obviously, because of lower production costs, right? So you can see that it will increase from OP0. Okay, I will call this E. OP0 E Q0. Okay, it will increase to O. Oh, sorry, my head is blocking, right? O. Maybe I just draw another. I just plot it across here. Okay, so we can see OP0 EQ0. This is the original producer revenue collected and original consumer expenditure paid. Now, because of a subsidy, you can see that producers will be incentivized to produce more, and producers receive a much higher price from the government. So we can see that the producer revenue will be OP1 AQ1. Okay, so you can see here. This one must copy OP1 A Q1. Producer receives a lot more. Okay, so producer is a winner here. Do you see that? What about consumer? You can see that consumer is also a winner. Okay, consumer expenditure is going to go through the same changes. They started off with the same point, O, P0, A, EQ0, which is the 4 points in black. O, P0, EQ0, and now you can see that consumers pay a lower price, P1, and they consume more, Q1. Okay, so if you were to stitch out the 4 points, it will be O, P1, B, Q1. Okay, so you can see that consumer expenditure will decrease from O, P1, B, Q1. So is it good news for consumer? Are they paying more or paying less? Type it out. Pay more. Are they paying more or paying less now?
Paying less.
Paying less. Good. Okay, so it's always good to pay less, right, as consumer. And as a producer, are they getting more revenue or less revenue now? Producer. More revenue. Right? Okay, producer more revenue, consumer less spending. So in between, okay, the government is going to foot the bill. So far so good. So for tax revenue is different. Tax revenue, both of them are going to be worse off. Okay, producer collect lesser, consumer pay more. Okay, so in a tax scenario, both of them are not going to be happy about that. Clear? But we're not concerned about happiness down here. Okay, happiness is a lot more normative statement, right? Whether you're happy or not, whether should you be happy or not, it's not my concern, right? Okay. So now, okay, listen carefully. This will be your exam question later. Now, you see that tax revenue is going to differ under different PED. Right? So this one must copy. I'm going to draw two different demand curves. Take your time. This one, take your time to copy. Okay, the flat demand curve will be elastic demand curve. Steep demand curve will be inelastic demand curve, right? Now, I'm going to draw a per unit tax. So far, so good. Now, I want you to observe. Okay, maybe I will use a rate demand curve here to show an inelastic demand curve. Sorry, I'm quite anal. Okay, something like that. Demand elastic, okay, and demand inelastic. Remember, our concern here is not so much, okay, today we want to find out tax revenue under these two demand curve, right? Now, okay, I want you to quickly, okay, jot out the tax revenue under these two. I'm not going to show the answer. Okay, once you are done labeling the tax revenue, you take a picture, send over to me. Okay, I want you to use this approach. Okay, tax revenue, okay, and show me exactly, okay, how much tax revenue, okay, is going to be reflected under both demand curves. I suggest you use a different colored pen for inelastic or elastic demand curve so that I can see your revenue clearly under the two different demand curves. So as Mr. Teo explained, quite straightforward, right? When you draw, then it's something not so straightforward. That you can agree. So a lot is about having the willingness to try. Okay, it doesn't matter if you get it wrong, but you must get your hands dirty. How? Are you almost done? Okay, so once you're ready, you can take a picture and send over. Thank you. So the trick for this is to use different colors. Then you can see clearly. Huh? Cora, are you done? Can you send a picture now? Not yet. You can WhatsApp me the photo. Okay, for the demand inelastic one, I think it's okay. But the one that is demand elastic got some problem. Okay, so I want you to focus. Okay, so first of all, okay, look at the screen. Okay, you can do it in green for your correction. Okay, so this is the equilibrium price and quantity. Okay, which I think you have. Okay, I know what is the problem already. Okay, so remember, okay, all three intersections must start at S0. Okay, your three intersections happen at the other curve. You see that? It's not at S1 plus tax. Okay, it must happen at S0. Okay, so this is your initial. Okay, and this is your equilibrium quantity. So regardless whether is it demand inelastic or demand elastic, this is where we start. Okay, holding your supply curve the same, S0. Are you following me? P0, Q0. Okay, so your biggest problem is you started at the wrong point. You start at the wrong point and no choice lah, Okay, so now I want you to observe that under the elastic demand curve, okay, we are going to have a more than proportional fall in quantity and less than proportional increase in price, right? And if we were to find out, okay, where is your tax revenue? Okay, so this, okay, will be your vertical distance. You see that? Multiplied by your horizontal distance from 0 to Q1. Tax revenue here. Following me? Now let's derive the one in red. So we can see that this will be the equilibrium price in red. Okay, and equilibrium quantity in red. Yes? And what else can we actually deduce here? we can see that the increase in price is met with a less than proportional increase in quantity. Do you see that? Increase in price, less than proportional increase in fall in quantity. So this is the vertical distance. You see that? Vertical distance, okay, multiply by what? 0 Q, the rate Q1. The rate Q1 denotes the demand inelastic. So what can we conclude about this? Between the black and the blue. Okay, which tax revenue is more substantial, the red or the black? Which one?
Red.
The red is black. So meaning to say the government can collect more tax revenue when, under which scenario? When the demand is price elastic or inelastic?
And the price is inelastic.
Exactly. Why is it that the government can collect more tax revenue when the demand is price inelastic? Why? Okay, remember what we learned about price elasticity? We are looking about the responsiveness of what? Quantity.
Price demanded to the price stream.
Exactly. So we can actually see that why tax revenue is higher under PED lesser than 1. Simple. Okay, because an increase in price is met with a lesser than proportional fall in quantity. Right? And therefore, your tax revenue is going to be bigger. It's the same approach. So this will be tested later on. Okay? No need to draw, but you need to know the idea behind that. Okay? It's all about elasticity. Increase in price will be met with a less than proportional fall in quantity. And there's also another way to look at this. So you can see that there are two different demand curves, right? So with a fall in supply, which is going to experience a greater extent of increase in price? Which one? Which demand curve will show you a greater extent of increase or fall in price? Increase in price in this case.
The elastic one.
Elastic or inelastic?
Elastic.
Okay, so you can see that your elastic one is black, right? You can see that when your supply curve shifts to the left, okay, your price is going to increase from P0 to P1 black. See that? What happens when your demand is price inelastic? Then you can see that your price will increase from P0 to P1 red. So my question is this. Under which demand curve will you experience a sharper increase in price?
The red one.
The which color? Red or black?
Blue.
Sorry, cannot hear. Under which demand curve will you... The red one,
Inelastic.
Inelastic. Okay, so the red one will experience a sharper increase in price. So in other words, what is going to affect the extent of your price increasing will be what? Your price elasticity, right? Yes, for a fall in supply, okay, your price elasticity of demand is going to affect, number one, the extent of the increase in price, and number two, okay, your amount of tax revenue that you're going to collect. That you following me? So is it more lucrative? Which one is going to be better for the government? To impose a tax on good that is price demand inelastic or price demand elastic? Which one? Inelastic or elastic? Which one is better for the government? Okay, so they are going to... for the government, in order for them to collect more tax revenue, then they want to impose a tax, okay, for on a good that is going to be more price inelastic. Okay, because they are going to experience a greater increase in tax revenue. Okay, so I have covered two concepts that will be tested extensively later. So I hope you got this. Don't need to draw this. This one don't need to cover. Okay, this is for H2 only, I won't be covering. Okay, so for exam purpose, you need to relate indirect tax to WETPIGS. And we will be covering extension topics to negative externalities. Okay, tax-based policies are normally related to market failure and negative externalities. Okay, so this will be covered in the future, not now. Okay, and welfare analysis is for H2 only. I won't be covering that. Okay, so with this, okay, this is the end of the content session. Okay, if you would like to dismiss earlier, then you faster go for a break and come back. Okay? We'll go through the questions together. See you in a short while. Okay, you back? So I want you to check whether you are seeing the same question paper, tobacco. Tobacco?
Yeah.
Okay, good. Tobacco. I just want to make a mental note. For page 21, okay, the colors that you see, okay, blue and yellow, okay, for whoever that's watching this, it's no longer relevant. Okay, it has been removed from the syllabus entirely. Okay, so this is the part that the students who are in the older syllabus should know. Right, so things that we have covered earlier on, okay, under the illustration of tax revenue, okay, it's not very different. Okay, so I have covered earlier on, okay, what are the I've given, if you have listened carefully, okay, if all of you have listened carefully, I would have covered how to approach B1 and B2. Okay, so I'm just gonna give you all a little bit of hints again. Okay, explain what determines the size of increase in price. Okay, so just now we have illustrated that the factor that affects the size of increase in price is what? What is that? Okay, in one glance. Extent of your price increasing. What's going to affect the extent of your price increasing when there's a tax? What's that? What's the difference between the black and the red?
That is elastic.
Okay, red is inelastic, right? Less sensitive to price changes. Okay, black is more sensitive to price changes. If you were to look from the other perspective, okay, the red will experience a higher, sharper increase in price. The black, more gentle increase in price. So this is how they are going to test you. Why is it like that? What is the factor that causes this? Okay, then you have to deduce why. Okay, you have to identify the factor, okay, that causes the size to differ. Okay, I've gone through the factor earlier on. Okay, what is the factor? Okay, what is the difference between the black and the red? Okay, both of them are demand curves, but how are they different? You gotta explain that. Okay? Try your best, okay, not to refer to the answer key and do it by your own. That's the best way that you can learn. I'm not saying that, okay, that you look at the answer key and do, but for whoever there is, who's watching this, okay, if you are over reliant on the answer key, then don't make sense, right? Okay, you're going for exam. The answer key don't exist in the exam. Okay, so 4 marks for this. For B part 2, okay, this is a 6 marks question. You want to break it down into thesis and antithesis. So the thesis is comment whether an increase in tobacco tax, okay, is the only reason for the trend in annual tobacco tax revenue. Okay, so this one, okay, I have covered here already. I'll give you a hint. I have covered it here, okay, under this particular slide. Okay, so if you are clueless how I derived that, I will suggest you to catch up, okay, with this particular slide. Okay, so the thesis, I have covered this already. Okay, so you probably have to use something that is related to price elasticity. Okay, so the antithesis, okay, is what? Okay, is asking you whether are there probably any other factors that could have caused your annual tobacco tax revenue to go in the same direction. See, comment on whether an increase in tobacco tax is the only reason, right? Okay, so the antithesis must be other reason. Okay, so you may want to find another reason that is not PED related. Okay? So I'm going to give you 30 minutes to do this. It's very comfortable timing. Okay, try your best not to refer to any answer key. Okay, and you can start now. So and if you end early, you can also let me know. Okay, I'll take over faster as well. Thanks. All right. Okay, time's up. Stop writing. Prepare your green pen. Okay, I will guide you through. Okay, what are the key terms to insert in your answer? Have your green pen ready? Okay, let's get started. Wait, where is the answer key? Up here. So for the students who haven't caught up with the outline that we have discussed earlier on, this is what I would suggest to catch up with, not the outline, okay, but how the part especially about I've covered about, what's that again? Give me a second. Yes, tax revenue under different PD. Okay, this particular part, okay, this is the main gist or the main focus of today's practice question. Okay, so explain what determines the size of the increase in price of tobacco following a tax increase. So concept that you want to relate to is this is what we call your WETPIGS factor. WETPIGS, right? Okay, WETPIGS factor will cause your supply curve to shift to the left. Cost of production will go up. So what's going to affect the size of the increase in your price of tobacco? Remember, we have red and black. So which one experience a sharper increase in price? We can see that the one in red, okay, is going to experience a sharper increase in price as the one in black. Okay, okay, so this one. Red P1 is going to be higher than black P1. So why is that so? Okay, so the factor that is going to affect the size of increase is what we call your price elasticity of demand. 1 mark for that. Okay, if you don't have that, okay, I'm not going to give you the first mark. And you have to explain what is the concept of PED. Okay, so number one, the next mark goes to the supply curve. Okay, cost of production of tobacco rises. This will cause your supply curve to decrease and shift to the left. Because demand is deemed to be price inelastic due to what? Okay, then you have to use a PANT factor. Okay, so PANT, you have proportion of income, availability of substitutes, okay, nature of good, time period, or necessity, degree of necessity. So addiction or addictive goods will be what? Okay, high degree of necessity. Okay, consumers are not going to be sensitive to price increment. Okay, so as long as I see the determinant, I'll give you the credit. Okay, and remember, this question, we are more concerned about a sharp increase in price. Okay, so you're going to illustrate less sensitive to price changes. Therefore, you can talk about quantity demanded will decrease by a smaller proportion, or you can talk about price increase will increase by a bigger proportion. Okay, bigger proportional increase in price. You can emphasize on this, bigger. Okay, or more than proportional increase in price, or you can focus on the quantity, smaller. Clear? Either way is fine. They are emphasizing on the same thing. Okay, so check how the marks are distributed. Are you done with your correction already? Okay, good. Okay, next question. So this is for clarification purpose. Okay, you can see that the increase in price, okay, will be more than proportion than your fall in your quantity. Or your quantity will fall less than proportion than the increase in price. Either way is fine. Okay, so make sure your demand is sufficiently price inelastic. Otherwise, you cannot get a sharp increase in price. Okay, so for this question, you need to uncover, okay, what? Okay, number one, okay, what is the annual trend in the annual, or otherwise the trend in the annual tobacco tax revenue? So we have to look at table 2, right? And what does table 2 tells us? Okay, we can see that your tax revenue is generally increasing, right? Yes? So 1 mark will be given to generally increasing. Now, okay, comment whether that an increase in tobacco tax is the only reason. Okay, obviously it's not the only reason, but you have to respect the question. So the TCs, right? So you can see that since demand for tobacco is price inelastic, okay, price increase will lead to a lesser than proportional fall in quantity demanded. And as a result, tax revenue will increase. So this is exactly what I have mentioned here, okay, under the red box and the black box. You can see that why is the red box bigger than the black box? A red box is going to experience a lesser than proportional fall in quantity with a given increase in price. Whereas the black box is going to experience a lesser than proportional increase in price, followed a more than proportional fall in quantity. Okay, so this is basically just elasticity again. Okay, the two concepts between B1 and P2 are awfully similar. So all I need to is just to relate to MTP or LTP. I will give you the credit. Okay, so you want to emphasize on the inelastic demand curve. Price will lead, increase in price will lead to a LTP fall in your quantity. Therefore, tax revenue rises. Yeah, this one we derived that earlier on. So the probably only challenge in this question, okay, is other factors. Okay, so I want you to focus on how other factors are constructed. So other factors, you can, if you realize here, I use a rise in English, this is an EG factor. Okay, EG factor is an income factor. Okay, so you can see that for tobacco, higher income will lead to higher demand. Okay, so you have to relate this to higher demand. So you can see that as a result of higher demand, okay, this will lead to an outward shift in your demand curve. Okay, so holding price the same, although we know that there's going to be an upward adjustment on price. Okay, but okay, holding your price the same, your quantity is going to be higher. Okay, so this is what it means. Okay, I am going to draw the demand curve down here. Okay, this is higher quantity. Okay, so this is what it means. Okay, I'm going to skip drawing the labeling the curves. So this is what it shows. Okay, when your demand increase from D0 to D1, okay, you can see that holding price the same. Okay, not to confuse with quantity demanded. Price the same. Okay, this is your quantity demanded. Quantity demanded. So you can see that quantity demanded increase. Do you see that? Okay, holding price the same. This is an EG factor. So when your Q goes up, okay, tax revenue is what? Okay, tax revenue is your per unit tax multiplied by your quantity. So if Q goes up, multiplied by per unit tax, okay, then your TR is going to go up. Your tax revenue is going to go up. So this is what it means. Okay, so how do we know this is a demand factor? Very simple. The thesis has already exploited the supply factor. No, it cannot be a supply factor. It must be a demand factor in your antithesis. Okay, so this is how we're going to connect the dots. Okay, for tax revenue, right? So this is a non-supply factor, supply and PED factor. Okay, so the thesis is a SS plus PED factor. Okay, so your antithesis cannot have SS and cannot have PED. Clear? Other than that, you can use any other EG factors. Okay, taste and preference also accepted. Okay, so long as it's EG. Okay, other than that, I don't see any other ways of doing this question. Okay? So have you gotten your corrections that you need? Okay. So very good. Okay, so that's it for today. So remember to turn in your script, okay, and your notes that you've taken, especially the colorful drawing that you have done, even the wrong or rather the diagram that is not so correct, okay, please attach as notes and send in to me as well, yeah? Okay, so with that, okay, that's it for today. Okay, so if you have any questions for me, especially for students that is not in this particular class, you can drop me via a private WhatsApp, or if you are watching this clip, okay, and you have no private access to me, you can drop a comment under the comment segment. Okay, I'll pick it up from there. Okay, otherwise, okay, I wish you all a good weekend ahead, and I will see you all.